You wake up, you grab your phone, and you check your brokerage app. You see the green numbers, you see the red numbers, and you feel a sense of control. You look at that portfolio balance, and you think to yourself, that's mine. I bought those shares. I own a piece of that company. It feels tangible, even though it's just pixels on a screen. But here is the hard truth that almost nobody on Wall Street wants you to dwell on. In the modern financial system, the concept of ownership has been slowly, quietly, and legally redefined right under our noses. What you believe is yours might actually be sitting in a legal gray zone, where, in a moment of extreme stress, the rules of the game can change. We are looking at a landscape that is shifting, and the tectonic plates underneath are being moved by the biggest names in the game. Institutions like JP Morgan, central banks, and a network of clearinghouses that most Americans have never even heard of. This isn't about scaring you into selling everything and burying cash in your backyard. That's not the point. The point is that knowledge is the only true defense in a system built on complexity. If you don't understand the rules, you can't protect yourself. And the rules regarding who actually holds the title to the assets in your brokerage account are far more slippery than the fine print in your user agreement lets on. So in this video, we're going to separate what's real from what's just hype. By the end, you'll walk away feeling calmer, clearer, and far more confident about what you're actually buying, and more importantly, why you're buying it. Today is Sunday, February 22nd, New York time. Drop a comment below and let me know the exact day and date you're watching this from. I love seeing where and when you're tuning in. And real quick, if you appreciate content that's built from scratch, thoughtfully researched, and never copied, support the channel by subscribing and commenting Henry's Market HQ below. It helps this channel grow more than you think, and I truly appreciate it. Let's start with a question that seems too simple to ask, but it's the foundation of everything. What does it actually mean to own a stock? 100 years ago, it was simple. You walked into a brokerage, you handed over cash, and they handed you a physical certificate. It was a beautiful piece of paper with an engraving, your name on it, and a wax seal. You put it in a safe deposit box, and nobody could touch it without you physically handing it over. That was ownership. That was tangible sovereignty over your capital. Fast forward to today, and we live in the age of the street name. When you buy a stock through an app like Robinhood, Fidelity, or Charles Schwab, they don't usually print a certificate with your name on it. Instead, the brokerage holds the asset on your behalf in what is called street name. This means the brokerage is the official shareholder of record, and you are the beneficial owner. For all intents and purposes, during normal times, this works perfectly. You get your dividends, you get your voting rights if you request them, and you can sell with a click. But the distinction between being the holder of record and the beneficial owner becomes a canyon when things go wrong. This is where we have to talk about a piece of legal architecture that sounds incredibly boring, but is actually the most important document you've never read. It's called Article 8 of the Uniform Commercial Code, or the UCC. Now, before your eyes glaze over, understand this. Article 8 is the rulebook that governs how securities are transferred and held in the United States. It was updated decades ago to make the financial system more efficient, to allow for electronic trading, and to remove the friction of moving paper around. And it succeeded. It created the fastest, most liquid capital market in the history of the world. But within that efficiency, there was a trade-off. Article 8 created a system of indirect holding. It allowed for what is called fungible bulk. This means that your shares aren't sitting in a little digital drawer with your name etched on it. They are pooled together with the shares of millions of other investors in a giant omnibus account at a central securities depository, like the Depository Trust Company, or DTC. You own a slice of the bulk, but you don't own specific identifiable shares. This pooling mechanism is the engine of the market, but it also creates a massive vulnerability. In the event that the intermediary, the broker or the bank holding the bulk, gets into financial trouble, the question becomes, whose shares are whose? Now, layer on top of this something called the hidden lien. This is the concept that scares the smartest money on the planet. The big banks, the prime brokers, the clearinghouses, they don't just store your assets in a vault and leave them alone. They are in the business of lending. They take the assets that are deposited with them and they use them as collateral to secure their own loans and trading activities. It's called rehypothecation. In theory, there are limits to how much they can reuse your collateral. In practice, the chains of lending and borrowing become so tangled that in a default scenario, determining who has the superior claim is a legal nightmare. Imagine you live in an apartment building, you pay your rent, you have your keys, and you consider that space your home. But one day, you find out that the building owner took out a massive loan using the entire building as collateral, including your specific apartment. If the owner defaults, the bank doesn't come for the owner, they come for the building. They can evict everyone to satisfy the debt. That is the hidden lien. Your brokerage is using the pooled assets. your assets, as leverage in the high-stakes casino of global finance. You don't see it, you don't agree to it in plain English, but the legal structure of Article 8 allows for it. And if you dig into the filings of major institutions like JP Morgan, you will see the sheer scale of the assets they pledge. They are not just pledging their own capital. They are pledging the street name assets held in custody for their clients. They are playing poker with your chips. Now let's pause right there and let that sink in, because the implications of what we just covered are massive, but they're still abstract until we attach them to real-world scenarios and recent legal shifts that have flown so far under the radar that most financial journalists haven't even whispered about them. We talked about the hidden lien, the concept that your assets are being used as collateral in a massive web of interbank lending. But here is where the suspense really starts to build. The question isn't whether the system is designed this way, it is. The question is, what happens when the music stops? What happens when a major player defaults, and all those pledges, all those rehypothecated assets get called in at the same time? This is where we have to look at the quiet updates happening at the state level, specifically regarding the UCC and how it interacts with global custody banking. There have been proposed amendments and discussions, nothing that makes the front page of the newspaper, that subtly tweak the priority of claims. In plain English, they are debating who gets paid first and who gets paid last when a brokerage or bank goes bust. And in every single one of these updates, the individual retail investor is at the back of the line, standing behind the behemoth clearinghouses, the Federal Reserve, and the largest financial institutions. Think about the hierarchy for a second. If you deposit cash in a bank, you have FDIC insurance up to $250,000. It's not perfect, but it's a backstop. For securities, we have SIPC, the Securities Investor Protection Corporation. SIPC protects you if your brokerage fails and assets are missing, typically up to $500,000. That sounds great, and it provides a psychological safety net. But here is the catch that very few people understand. SIPC protects you against the insolvency of your broker. It does not protect you against a drop in the market value of your assets. But more importantly, it doesn't fully protect you against the kind of systemic breakdown we are talking about, where the assets aren't missing because of fraud, but because they are tied up in a legal battle over priority. If the depository trust company, the massive central hub where the electronic ownership records are kept, were to face a major default by one of its participants, the rules dictate that the assets of the biggest players are untangled first. The small accounts, the beneficial owners, are left waiting while the lawyers sort through the fungible bulk. Imagine a run on a bank, but instead of cash, it's a run on the collateral that backs the entire derivatives market. That is the nightmare scenario that central bankers and treasury officials game theorize about in closed-door meetings. They call it a liquidity crisis, but for the average person, it would feel like a seizure. It would feel like the market opened one morning and a chunk of your portfolio value had been legally reallocated to cover someone else's bad debt. This brings us directly to the role of the central banks and the largest custodians, like JP Morgan. JP Morgan is not just a bank you walk into to open a checking account. It is one of the largest custody banks in the world. They hold assets for pension funds, for sovereign wealth funds, for hedge funds, and for the underlying clients of smaller banks. They are the bank's bank. They are the keeper of the keys. And when you read about the health of the financial system, you often hear about stress tests and capital ratios. But the stress tests rarely model for a scenario where the collateral itself becomes contested. If JP Morgan, as a custodian, has lent out securities to generate yield, a practice that is completely standard and legal, and the borrower goes bankrupt, JP Morgan has the right to use the collateral it holds from other clients to backfill that loss. That is in the contract. It is buried in the hundreds of pages of terms and conditions you clicked agree on without reading. They call it a right of set-off, or a security interest. It is the legal mechanism that allows the custodian to protect its own balance sheet using the assets in its custody. Your assets. In a moment of extreme stress, the logic goes, the survival of the system depends on the survival of the major institutions. So the rules are written to protect the institution first and the client second. Now, let's connect this to the global headlines we've been seeing. Over the last few years, we've witnessed banking crises that were contained. Think Silicon Valley Bank, think Credit Suisse. But they were contained by extraordinary measures. We saw the Federal Reserve step in with emergency lending facilities that allowed banks to pledge assets at par value, effectively ignoring market losses. We saw regulators engineer fire sales and mergers to prevent a full-blown collapse. But each time, the mechanism of seizure was quietly refined. The playbook got updated, the legal framework got strengthened, and the trend is unmistakably moving toward centralization and control. The concept of the Great Taking isn't about a villain in a boardroom twirling his mustache and pressing a seize button. It is about a slow, methodical evolution of the law that creates a system where, in a crisis, the assets of the many can be legally mobilized to save the few. It's about the difference between a bailout funded by taxpayers and a bail-in funded by depositors and investors. We saw a preview of this in Europe during the Cyprus banking crisis, where uninsured depositors took a haircut. We saw it in the fine print of the bail-in regimes that were established after 2008, which explicitly allow regulators to wipe out shareholders and bondholders, and even convert deposits into equity to keep a bank alive. The United States has similar frameworks on the books now, buried in Dodd-Frank and subsequent regulations. The infrastructure is built. The legal arguments have been tested in academic journals and law reviews. And the asset management arms of the big banks have been quietly restructuring how they hold collateral to ensure they are in the most protected class. They are preparing for the storm by making sure they have the lifeboats, while the retail investors are still marveling at the view from the deck. The suspense isn't in whether the system is rigged. The suspense is in what happens when the rigging is finally tested by a real, global, cascading default. That is the moment the headlines will change from market correction to something far more sinister, something that looks a lot like the legal reallocation of wealth on a scale we have never seen in peacetime. And if you aren't watching the UCC amendments, if you aren't paying attention to the global custody battles, you will wake up one morning and wonder where your digits went, wondering why the rules changed while you were sleeping. The banks aren't waiting for a crisis to build their defenses. They are building them right now, in the language of the law, in the fine print, in the quiet whispers of state legislatures. And the only way to defend against something you can't see is to first admit that it exists. That is where we are right now. That is the ledge we are standing on. And in the next part, we're going to look at what you can actually do about it, how you navigate a world where the old rules of ownership no longer apply in the way you think they do. Because knowledge is the only hedge that doesn't have a counterparty. Knowledge is the one asset they can't rehypothecate. So here we are, standing on the edge of understanding, looking into the abyss of a financial system that operates on trust and legal fine print rather than the tangible ownership our grandparents took for granted. The question that should be burning in your mind right now isn't just, is this really happening? But rather, what do I do with this information? Because knowledge without action is just parlor trivia. It makes for interesting dinner conversation, but it doesn't protect your family, your retirement, or your future. And that is exactly what the architects of this system are counting on. They are counting on the fact that even if you know the rules are stacked, you'll feel powerless to change anything. They want you to throw your hands up and say, well, if JP Morgan and the central banks are going to do what they want anyway, why bother? That resignation is the ultimate victory for them. But here is the truth that the power brokers don't want you to hear. Understanding the game gives you the power to change how you play it. You cannot control the laws, you cannot control the hidden liens, and you cannot control what the clearinghouses do in a crisis. But you can control your own exposure, you can control the counterparties you trust, you can control the structure of your own wealth. And in a system designed to strip you of control, reclaiming even a small amount of agency is the most radical act of financial defiance available. Let's start with the practical steps, the tangible moves you can make to sleep better at night, knowing that you've at least considered the worst-case scenario. The first and most obvious layer of defense is diversification, but not the kind you hear about from financial advisors who just want you to buy a little bit of this and a little bit of that. I'm talking about diversification of custody and diversification of asset type. If all of your assets are held at a single brokerage, you are creating a single point of failure. You are putting all your trust in one institution's ability to weather a storm and one institution's interpretation of the UCC. Consider spreading your holdings across multiple unrelated custodians. Consider holding some assets in physical form if possible. Now I know what you're thinking. Physical form? We don't get stock certificates anymore. That's true for most publicly traded companies, but there are ways to register shares directly with a transfer agent through something called Direct Registration System, or DRS. This pulls your shares out of the street name pool at the depository trust company and registers them directly in your name with the company's transfer agent. It doesn't make you bulletproof, but it does remove a layer of intermediary risk. It makes it harder for your shares to be lent out or rehypothecated without your explicit consent. It's not a perfect solution, and it comes with its own trade-offs in terms of trading speed and convenience. But it is a step toward reclaiming the definition of ownership that existed a century ago. It is a vote for transparency in a system built on opacity. Beyond stocks, we have to look at the broader landscape of assets. The banking system is a miracle of convenience, but convenience is the enemy of sovereignty. Consider holding a portion of your liquid net worth outside the traditional fractional reserve banking system. This doesn't mean stuffing cash under your mattress. That's impractical and carries its own risks of theft or fire. but it might mean holding assets that have no counterparty risk at all. Assets that are what they are, not promises of what they are. This is where the conversation inevitably turns to tangible assets, to hard assets that exist independently of any ledger entry. Real estate, if you hold the deed directly, is a tangible asset. It's dirt and sticks and bricks. It can be taxed, it can be regulated, but it cannot be rehypothecated by a bank in another country without a clear chain of title that you control. Precious metals, physical gold and silver, held in your own possession, not in a bank vault allocated to you, but in a pool, but actually in your hand, or in a private vault you control directly. These have no counterparty risk. A bar of gold doesn't care if JP Morgan goes bankrupt. A silver coin doesn't care if the Federal Reserve prints $40 trillion. It simply is what it is. Now, I'm not saying you should convert your entire 401k into gold coins and bury them in the desert. That's a movie plot, not a financial plan. But I am saying that a thoughtful allocation to assets outside the digital ledger system is a hedge against the very scenario we've been describing. It is insurance against the failure of the digital custody system. You don't buy insurance because you expect your house to burn down. You buy it because you want to sleep at night knowing you're protected if the unthinkable happens. A small allocation to tangible, self-custodied assets serves the same psychological and practical purpose in a portfolio. Now let's talk about the mindset shift that has to accompany these practical steps. The financial industry has spent decades conditioning us to measure wealth exclusively in digital numbers, in account balances that fluctuate by the second. They've turned investing into a video game where the goal is to see your number get bigger than someone else's number. But that gamification has a dark side. It disconnects us from the reality that those numbers represent claims on real things, on future production, on corporate earnings, on the labor of others. When you internalize the lessons of the great taking, when you truly understand how the plumbing works, you stop being a passive participant in the game and become an observer of the game. You start asking different questions. Instead of asking, what stock is going to go up tomorrow, you start asking, who is the custodian of this asset and what are their rights if things go wrong? Instead of asking, what's the hottest IPO, you start asking, is this asset held in street name or can I register it directly? These questions make you annoying to your broker. They make you a difficult customer, and that is exactly what you want to be. You want to be the customer who asks the hard questions, who reads the fine print, who forces the system to reveal its biases, because the system is optimized for passive compliance. It is optimized for people who click, I agree, without reading. Every time you refuse to be that person, you reclaim a tiny sliver of power. And let's be honest about the emotional toll this knowledge takes. It is unsettling to realize that the ground beneath your feet isn't as solid as you thought. It is uncomfortable to look at your brokerage statement and see it not as a scoreboard, but as a web of legal obligations and potential failure points. But discomfort is the price of clarity. The person who lives in blissful ignorance is the one who will be blindsided when the rules change. The person who allows themselves to sit in the discomfort, to really stare at the machinery, is the one who will adapt, who will pivot, who will find the cracks in the concrete and slip through them. This is not about fear-mongering. It is about clear-eyed assessment. The financial world is not coming to an end tomorrow. The sun will rise, the markets will open, and most people will go about their business completely unaware of the fault lines beneath them. But for you, now that you know, every decision carries a new weight. You will look at headlines about banking crises differently. You will read about UCC amendments with a new curiosity. You will hear the phrase, too big to fail, and understand that it actually means too big to fail without taking your stuff to cover their bets. So where does that leave us? It leaves us with a choice. The choice to be informed and active, or the choice to be passive and hopeful. Hope is not a strategy. Hope is what they sell you while they quietly rewrite the rules. The architects of the modern financial system are not evil mustache-twirling villains, but they are rational actors pursuing their own interests. Their interest is in stability, and if that stability requires the legal reallocation of assets from the many to the few, they have built the machinery to do exactly that. Your job, if you choose to accept it, is to build your own machinery of protection. It is to understand the difference between a beneficial owner and a holder of record. It is to understand the priority of claims in a default. It is to understand that the bank is not your partner. It is a counterparty with interests that may one day diverge sharply from your own. This is the moment where you decide. You can close this video, go back to your day, and forget everything we talked about. That is the easy path. That is the path of least resistance. Or you can take this information and let it change you. You can let it make you a more skeptical, more diligent, more sovereign participant in your own financial life. You can start asking the hard questions. You can start diversifying not just your assets, but your custody structures. You can start building a life that is resilient to the failures of the system, not dependent on its flawless operation. That is the path of the free. That is the path of the prepared. And that is the path I hope you choose. Not because the sky is falling, but because the sky has always had cracks in it, and the wise build shelters long before the rain starts to fall. If you are benefiting from our topics, please subscribe, like, and turn on the bell notification so you can see our new videos early. This channel exists because of you, because of the curiosity you bring, because of the questions you ask. I read the comments, I see where you're watching from, and I build each video with you in mind. So drop a comment below with your take on all this. Do you feel more prepared? Do you feel more concerned? Do you think I'm completely off base? Let's have the conversation in the comments. And until next time, stay curious, stay skeptical, and stay sovereign. I'll see you in the next video.